Catherine.
Hi, Anushka.
Thank you so much for tuning in today. Do you want to tell me a little bit of an introduction about yourself?
Yes, of course. So my name is Catherine. I'm head of ratings at Bank.Green. Bank.Green is a non-profit organization. We're entirely volunteer-led, and the mission of our organization is to help individuals and businesses align their banking practices with their values. So we rate banks based on their environmental performance. We look at whether these banks lend to fossil fuel companies and also to the renewable energy sector. And then we provide individuals with an assessment of how their bank stacks up and also provide alternatives as to the more sustainable banks that they can choose as an alternative.
Cool. That sounds great. Thank you. And where are you tuning in from?
I'm joining you today from Los Angeles, where last week we're recording this on January 14th. Last week, a number of neighborhoods in the city were obliterated because of catastrophic wildfires. And we know that this is driven by temperature increases and droughts. And scientists have concluded that these fires were made more likely, and in terms of their severity, they were twice as severe as typical wildfires during this time of year because of these warming temperatures that are caused by burning of fossil fuels. So this issue is personal to me as we speak today, and we talk about this issue today. Yeah.
Yeah, definitely. And so just diving in, I'd love to ask you initial question of, okay, so Bank.Green's analyzing banks, but how do banks actually work? How can we break them down?
Yeah, no, great question. Banks, there's very different types of different financial institutions that provide banking services, and we'll look into that spectrum in one of our upcoming videos. But just in a nutshell, banks make money in three different ways. First of all, they make loans. So they take customer deposits and then they lend to either retail customers, so individuals or businesses or both. And we'll look at an example a bit later. Second is they hold bonds. So they invest in financial assets and receive investment income. And then finally, they engage in underwriting. So they act as intermediaries and facilitators to help businesses get funding. Sometimes they operate alone. Sometimes they enter into what we call syndicated arrangements. So they work in collaboration with other banks to provide funding for businesses.
Cool. Thank you. And another question, just from someone who doesn't know too much about banks. If I give a bank $100, what happens to that $100?
Yeah, great question. And before I answer the question, and we can just dive in and take a look at an example, banks have diversified portfolios. And by that, I mean that for risk management purposes, they need to have a really broad spread of where their lending or investments go. So no bank puts 100% of the money that they have in their balance sheet into, say, fossil fuels, right? Or transportation or agriculture or another industry, right? So they need to have a diversified portfolio across a number of industries. And what we find in the course of our work is, on average, about 2 to 5% of a large bank's lending portfolio will be allocated to the fossil fuel industry. But don't take my word for it. Let's take a look at an example. This is an example of Barclays. It's one of the largest banks in the UK. And what you're looking at here is a balance sheet. So if we look at the liability section, you can see this line item, deposits from customers. At the end of last year, had 524 billion pounds of cash they've taken as deposits from customers. And if we go up, so you can see this line item, this is how much they lent out in loans to individuals and businesses, 333 billion. Now, it's a little bit more complicated because there are different types of assets that they're showing in different line items, but really simplistically, that's what's happening here. Where does this money actually go? Barclays has really helpfully provided a breakdown of that lending by industry. And if you remember, it was 333 billion, 311 of that went to what they describe as carbon-related sectors, so high carbon emitting sectors. And you can see automotive, chemicals, metals, etc. And you can see they've got line items here for oil and gas refining, oil and gas extraction, oil and gas wholesale. It's worth noting that fossil fuel industry has different phases. So you start with extraction, then production, refining, transportation, downstream transportation, etc. So there's different subsectors. But at the bottom, what you can see is Barclays has really helpfully told us that the total lending to the oil and gas sector is £8 billion, and that is about 2% of their total portfolio of commercial lending. Now, 8 billion maybe doesn't sound all that much, but there are 50,000 banks in the world, and across top 60 banks, we know that they funded $6.9 trillion worth of, they provided $6.9 trillion of lending to the fossil fuel industry since the signing of the Paris Agreement in 2015. So it does all add up.
Definitely. Thank you for that. And I saw, obviously, we analysed that Barclays lends 2% of its money towards the fossil fuel industry. But as we know, different banks lend different amounts or invest different amounts. And therefore, I'd love to ask, why does this happen? Why do different banks put different amounts of money into fossil fuel funds?
Yeah, sure. There's a number of reasons for that. Smaller banks don't have as much capacity to invest in these big projects. Larger banks have a lot more capital to invest. But also these portfolios, they're dynamic, right? They're not static. And banks are always looking out for the combination of two factors, right? And they tend to track the sort of the wider sentiment in the global economy. They always want to minimize their risk. So they're always looking for safe investments, but they also obviously want to maximize their return. So they're looking at industries that are cash generating, that are safe for them to invest in. And whenever oil prices are high, that means that the oil industry is really attractive in terms of investment and lending. When, however, we have corrections where oil prices maybe drop because of a global crises or because renewable energy is being subsidized increasingly in different jurisdictions globally. So they're just accordingly. We saw that several years ago when banks all rushed in to put a lot of money into renewable energy, and they scaled down that investment as oil prices rose after the war in Ukraine started. It's dynamic, and some of them are more opportunistic and more bullish when it comes to the fossil fuel industry.
Cool. Great. Thank you so much. That's everything from me that I have to ask this week. And this week we analyze more how banks work, and next week we'll look more into why banks will put money in certain places. So I'm looking forward to that, and thank you so much for enlightening us with your knowledge.
My pleasure. All right, take care, Anushka. See you soon.
Thank you,
Bye.
Catherine.